Good morning once again. Just for a quick introduction, I am Suraj, Chartered Accountant and CMA UK qualified. I head the content at Indigo Learn and I teach financial reporting, accounting standards, Ind AS, IFRS, and related aspects. Right. So without wasting any more time, let us quickly start the standard on revenue recognition, which is covered by IFRS 15. Equivalent Indian standard, Indian accounting standard, if you look at it, is Ind AS 115, right? Let us understand some background to why a detailed standard like IFRS 115, IFRS 15 is needed. Please remember, this is one of the lengthiest and complex standards and has a very much wide application. And whenever you look at a financial statement, the first thing that comes when you look at the P&L, the first item you see is revenue. And the entire business ecosystem works around this revenue. If you are able to recognize revenue correctly, your financial statements will give you a true picture. If you are not able to recognize revenue correctly, your financial statements will not give a true picture. Now, earlier also we had revenue related guidance, but the reason why a detailed standard was needed is because of changing business environment. Now, what has changed? What kind of business environment are we talking about? To give you a very, very simple example, if I talk about Indigo Learn, IFRS is not applicable, but still, if I talk about Indigo Learn or some business which is like Indigo Learn, then what we do, we record classes and we sell these recorded classes. Of course, we have also live classes and all going on. We record classes and we sell those classes. So hypothetically, assume we are in April of a particular year, let us say year one, right? We are in April of year one, and in April of year one, some student like you, he liked my FR classes and he came and he said, okay, let me buy these FR classes. He purchased the FR classes for 10,000 rupees. So he paid us 10,000, and in April of year one, I have collected 10,000. Now, normally what you would do, you would say debit bank, credit sales, 10,000. Right. Now, let me add some more information to this. Say, for example, this student who had purchased in April 1 had purchased this FR classes, which is valid up to November of year 2. Means what? We are talking about April of year 1 to March of year 2. This is one financial year. April of year 2 to March of year 3. This is the second financial year. Now, a student has paid me an amount of 10,000 to access the classes over 2 financial years. Earlier, when detailed guidances were not available, generally what company used to do is they used to say, okay, let us recognize this 10,000 in year 1 itself. In fact, if you have followed the news, Byju's accounting, in fact, I've done a video on that also. You can check it out on our YouTube channel. Byju's accounting, if you look at it, it was about what? Revenue recognition. They are selling courses for 3 years, 4 years, 5 years, and recognizing entire revenue upfront. Okay. So that is where and it was with IFRS. Okay, Ind AS was applicable, but still they try to, play around with that, saying that 80% is towards books we have already delivered, 20% is towards content. All of those things went on. So it is very important to recognize revenue appropriately. I cannot say that this entire 10,000, because the student has paid me, I have given the class access, entire 10,000 can be recognized as revenue, because I have an obligation, I have a responsibility to give you classes over a period of 2 years or whatever the duration you have purchased. This is still a very simple example. If you look at things like, let us say, Netflix, if you take an annual subscription, or you take a look at Amazon Prime, you take an annual subscription, and with that you will get to watch content. With that you will get to some access to Prime Music. You have so many things going around. So appropriately we need to identify what portion of revenue should be recognized and how should we recognize that revenue. I'll give you one more example. A lot of you would have heard about when Jio was launched, they had this some handset bundling scheme, where they said you pay some amount upfront, we will give you device, and we'll also give you access for 1 year or 2 years of data, okay, or phone calls. So you have purchased handset, plus you get access to calls over 2 years. Okay, or think of a case where these days companies come and say, if you look at a broadband connection, let's say you go to Airtel and Airtel says, I will give you broadband connection, 1 year scheme. In this 1 year scheme, you have to pay us, let us say, some 8,000 rupees. For 1 year, you have to pay us 8,000 rupees. Now, with this 8,000 rupees, what all will I give you? I will give you one set-top box to access TV channels. Then I will give you one Wi-Fi router. I will give you broadband services. I will also give you telephone connection. Okay. So here is where Airtel is giving me one set-top box. Now that set-top box will be returned back if I cancel the subscription. And they are also giving me a Wi-Fi router. That Wi-Fi router I can keep with me. Then they are giving me services of TV channels, broadband services, telephone connection. So many things bundled into a single 8,000 rupees contract. How should we recognize revenue? When should we recognize revenue? All of this is what will be given or what will be given as a guidance under IFRS 15. Normal purchase and sale of goods is very simple. I sell a good, I purchase a mobile phone. With that mobile phone, when I get the mobile phone delivery, the seller will recognize revenue. But then, if the seller says, I will sell a mobile phone plus 2-year extended warranty. So mobile phone and 2-year extended warranty all put together, let us say 9,999. This is the price. Now, this 9,999, I have to identify how much is towards sale of mobile phone and how much is towards this extended warranty. And warranty, I will recognize over a period of time. Mobile phone, I'll recognize the moment I transfer the phone to the customer. Same thing. A lot of you would be, owning 2-wheelers, or, your parents may be having 4-wheeler, or yourself may be owning 2-wheelers or 4-wheelers. Again, there what happens? You purchase a 2-wheeler, and with that, there comes a booklet which says 4 free service, 5 free service. No, they are not actually free services. They have collected that amount upfront as a part of the overall sale transaction. So how should we split that? If I pay 1 lakh rupees to purchase a 2-wheeler, how much should I allocate towards the sale of 2-wheeler, and how much should I allocate towards the annual maintenance contract or the free service that we talk about? All of that guidance is properly given under IFRS 15. So I gave a lot of examples to help you understand where are we heading. Okay, so the overall core objective, if you look at, it is all about identifying what is the type or what is the contract, then splitting. The most important part here would be this, for example, 9,999. How do I split between mobile phone and extended warranty? Or this 10,000 rupees, how do I split over a period of time? Or this handset bundling scheme, how do I split that? That is what is the guidance given under IFRS 15, right? This is the broad objective, or this is a broad area what the standard covers, right? I hope so far it is very clear because I've just given you examples. If you have any questions, you can ask me, or we'll continue with the guidance given under IFRS 15, right? Because these are just examples. Now, coming to IFRS 15, and the most important part of the standard is what we call the 5-step model. This is not something which is new, but they have given it as a proper structure. So we have to follow something called as 5-step model. Now, what is this 5-step model and how do we apply this 5-step model? That is what we will be understanding, right? Now, under the 5-step model, the first model or the first step, step 1, is identify the contract. Identify the contract. Contract between whom? Contract between the supplier and the customer. So there has to be a contract between 2 parties or more than 2 parties for us to bring something under Ind AS 115 or IFRS 15. Okay. So step 1 is what? Identifying the contract. Now, contract can be written. You actually physically enter into a contract. It can be oral also. Like now, what can be an oral contract? You go to a shop, you say, I like this particular item. You pay the amount, you take the delivery. So that is also a contract. Or you order something on an application, Swiggy, Zomato, Amazon, all of these, you are entering into online contracts, written contracts. You agree to terms and conditions, right? So there is also a contract. So there has to be a contract for us to recognize something under, IFRS 15. Okay. If there is no contract, then revenue cannot be recognized. So then what do we do with, let's say we get something from the government. Government gives us some amount. You cannot call it revenue. If the government gives us, let's say 10,000 rupees, just as some amount to encourage us to do something, or like a government grant, that cannot be called a revenue because there is no contract. So there has to be a contract. The first step, there has to be a contract, and you must be able to identify the contract to bring something within the purview of IFRS 15. And same thing we will learn for IFRS 16 also under leases, that there has to be a contract. And there is a customer, there is a supplier, and there has to be a contract. Like if you purchase something, as I told you, there is a contract, there is an implied contract, there can be an actual contract, there can be a written contract. So, but there has to be a contract, right? And the revenue will be recognized on a contract basis. So on a contract to contract basis, you will be recognizing revenue, right? So if I go back here, this 1 year scheme, there is a contract that the company will give me a set-top box, it will give me access to TV channels, it will give me a router, it will give me broadband services, it will give me telephone connection against a consideration of 8,000. That is what is the contract. Okay. So first step, as I told you, is what? Identify the contract. The second step, for which I have given you a lot of examples already, is identify the separate performance obligation within a contract. So there is a contract. Second step is identify performance obligation. Now, this term is self-explanatory. Of course, IFRS 15 gives us more details about, what is a performance obligation. But to give a very simple example, you purchase classes from us. What is my performance obligation? To give you access to lectures, to conduct mock tests, to clarify your doubt. All of these are my performance obligation. Now, an entity must be able to identify each performance obligation separately. See, clearing doubt is bundled along with providing the classes. So that is one. Mock test, if I conduct mock test separately, if I sell mock test separately, that is a separate performance obligation. Now, performance obligation means what is the supplier going to do, or what is the supplier obliged to do? That is what is called performance obligation. To put it very simply, here, performance obligation is to give the set-top box, to give access to TV channels, to give you Wi-Fi router, to give you broadband services, to give you telephone connection. All of these are performance obligation. So what is the obligation of the supplier? What is the obligation of the supplier towards the customer under the contract is called performance obligation. So what is the supplier bound to perform? That is the performance obligation. Okay. So here we talked about this one, mobile phone plus 2 year extended warranty. So one performance obligation is to give the mobile handset. The second performance obligation is to cover the warranty for a period of 2 years. So you have to identify what are the performance obligation, right? So next time, whenever you enter into a purchase sale contract, means whenever you purchase a product, you please have a look at what are the performance obligation. That will help you understand. For example, we talk about Amazon. Okay, you purchase something on Amazon. Now Amazon says 10 days replacement. So for 10 days period, you have a window to replace, correct? So Amazon will deliver the goods to your doorstep, and you have a right, or you have a choice to, exchange the product. Till the time the 10-day period is not over, the performance obligation of Amazon is not completed. Again, if you go to a shop, let's say you go to a shop and you purchase some item. Now, when you go to a shop and you purchase some item, the performance obligation is the seller has to give you the product. But if you buy something on Amazon, the performance obligation is not only to, deliver the product, that the product has to be delivered at your doorstep in a proper condition, and you have to accept it. So this is what we call performance obligation. Okay. So in some cases, it will be like you go to the shop, the moment shopkeeper hands you the product, the performance obligation is completed. In cases like, let's say, online purchases and all of that, till the time the customer receives the product in the condition what he wants, till that time the performance obligation is not completed. So first step, identify the contract. Second step, identify the separate performance obligation within a contract. Then the third step, again a very important step, is to determine the transaction price. So step 3, determine the transaction price. Now you might be thinking, sir, what is the big deal in identifying the transaction price? Transaction price is nothing but the amount that the customer will pay to the supplier, correct? As simple as that, right? Transaction price means what? I go to a shop, a product is worth 1,000 rupees. I pay 1,000 rupees. That is the transaction price. That is in most of the normal circumstances. But a lot of time what happens is transaction price, for example, just to give a simple case, customer will pay after 2 years. Customer will pay after 2 years. So if customer will pay after 2 years, let us say 10,000. Is this 10,000 after 2 years equal to 10,000 today? It is not, right? Because today, if the customer has to pay 10,000, on that 10,000 over a period of 2 years, the supplier will earn interest. But here, 10,000, when we say that there is amount which is payable after 2 years, we have to see what is the present value. And that present value will be the transaction price and not the 10,000 that the customer will pay after 2 years. Okay. Contract may say anything else, but you have to understand what actually is the transaction price. Another situation could be, I'll give you a very simple example. Say, for example, today we use AWS. Say, for example, we use AWS. AWS for what? For all the streaming services. Okay. AWS for all the streaming services. We are a customer. AWS, Amazon is the supplier. IndigoLearn is the customer. And we are using what? AWS services to host our website, to store our content. All of that is being handled by AWS. Okay. Now, what happens is Microsoft sees that, okay, there is a lot of potential in this particular company, IndigoLearn. So let us pitch our product to IndigoLearn. Currently, we are using what? AWS. Now Microsoft comes. Okay. Now Microsoft says, please switch over from AWS to Microsoft. Switch from AWS to Microsoft. We say switching is a lot of painful activity. We have to move everything, all this data. It will take a lot of time and effort. So we don't want to shift because costing wise, mostly it is same. It is not worth it. We will not shift. What Microsoft says is, don't worry. If you agree to shift, we will give you some incentive. Oh, so here, what has happened is customer is not paying something to the supplier. Supplier is paying something to the customer. So how do we handle these scenarios? That also we need to understand. Or maybe there is a penalty that IndigoLearn will have to pay to AWS for cancelling the contract. Then in that case, also we have to see if Microsoft is reimbursing a part of that, how do we handle it? So here, transaction price, one is normal, your price of the contract. That is okay. But apart from that, there may be something which the supplier may pay to the customer. How do we adjust that? Or there may be something where the supplier is compensating to the customer. How do we handle that? That is what we need to understand. Another thing what happens is, sometimes what happens is, let us say we purchase a machinery. Okay, we purchase a machinery. But the customer thinks that we are not sure of the performance capacity of the machinery. We are not sure of the quality of the performance of the machinery. Then in that case, how do we negotiate a contract with the supplier? Say, for example, I want to purchase a machinery. I am a customer and I have to pay, let us say 1 crore. Okay, 1 crore is payable. Now, paying 1 crore is fine, but I'm not sure what is the quality of machine. What if the quality of the machine is bad? What if I don't get proper production? So what the supplier says is, okay, do one thing, my dear customer. You pay me 80 lakhs upfront. You pay me 80 lakhs upfront. Then, based on the production, give me variable payment. You are worried about the performance, right? So, how the machine performs, what is the output of the machine? Based on that, on per unit basis, pay me some amount. So here, one consideration is fixed, another consideration is variable. How do we handle that? That is also very, very important. Okay, so this happens normally in cases where customer wants to safeguard himself. So in that case, how should we recognize revenue? Do we say 1 crore is the revenue or 80 lakhs is the revenue? So all of those aspects is what we'll be understanding under the transaction price. So the third step is to determine the transaction price. And don't worry, we'll take numerical examples also. We'll take more questions also for us to understand how do we apply this 5-step model. Right now, we are just taking the broad overview of the 5-step model. So first step is identify the contract. Second step is identify the performance obligation. Third step is determine the transaction price. Transaction price, there will be some complexities around, a prepayment, payment after some period of time, variable consideration, payment by the supplier to the customer. All of those things will be covering. Then step 4, the next step is allocate the transaction price to the performance obligation in the contract. So this is the step that will determine how much will be the revenue. Okay. For example, here 8,000 rupees. 8,000 is what? Your transaction price. Now what you need to do is this particular 8,000 you have to allocate between the set-top box, the Wi-Fi router, the broadband services, and the telephone connection. And you have to say, okay, for this performance obligation, this is the transaction price. For this performance obligation, this is the transaction price, right? So that is the 4th step where you will allocate the transaction price to the performance obligation. Okay, that is the 4th step. Then last step, step 5 is recognize revenue as performance obligation is completed. This is the 5th step, which is more simpler step. What we are saying is, as and when you complete a performance obligation, you recognize revenue. So, for example, if a performance obligation is to give you mobile phone and 2 years of warranty. So, in that case, what you will do is, the moment I give a mobile phone, the performance obligation towards the mobile phone is completed. So, proportion of transaction price which you have said, okay, this is for the mobile phone, that you can recognize revenue. Then warranty, as you complete 1 year, you will be able to recognize the revenue. Now, what I'll do is I'll take a small number, that will help you understand better. Let us say mobile phone and 2-year warranty. Okay, both put together, total amount is 10,000. Both put together, total amount is 10,000, and assume for a moment, based on our calculation, we say that 9,000 is towards mobile phone and 1,000 is towards 2-year warranty. Okay, 1,000 is towards 2-year warranty. Now, customer has paid how much? Customer has paid 10,000. So you will debit bank 10,000. Now, the moment I receive 10,000, I give the mobile phone. So credit revenue 9,000. And this 1,000 that I've collected, that is towards what? That is towards 2 years warranty. So you will say credit liability 1,000. So why credit or liability? Because we have not yet completed the performance obligation. I've collected 1,000, but I have not completed my performance obligation. So because I have not completed my performance obligation, that amount is a liability. So after end of 1 year, I will say debit liability 500, credit revenue 500. At the end of 2nd year, I will debit liability 500, again credit revenue 500. Okay, so that is how I will recognize revenue at different points in time. If a student purchases a class from me, we don't follow, we are not required to follow IFRS, but again, logically speaking, if a student purchases a class from me and that class is valid for 2 years, I have to split it and I have to account it over a period. So I have to recognize revenue accordingly. For example, I tell to my students that for ACCA classes, for example, you pay us some amount for class fees and registration that will include multiple items. So ACCA registration, live classes, and ebooks. Okay, for these 3 things, I collect a lump sum amount from the customer. So I have to split that amount between ACCA registration, say for example 3,000, live classes, say for example 6,000, books 2,000. So like this, I have to split, and the moment I deliver the books to the customer, I have to recognize revenue. The moment I start delivering the classes to the customer, to the students on a monthly basis, now let's say it's a 3-month class. After the 3 months are over, I can recognize the revenue of 6,000. ACCA registration, the moment I complete the formalities of ACCA registration for the student, I have to recognize revenue of 3,000. So this is how it works. And till the time the performance obligation is not completed, you will say that this amount that you have collected from the customer is nothing but a. So I have in about 30 minutes given you the entire gist, the 5-step model. We'll go into each step again in detail, but so far, whatever we have covered, if you have any doubts or if you have any questions, please feel free to ask.
Yes, sir. Sir, in any circumstance, is that possible that all the revenue is recognized to the main product only and the extra benefits can be recognized as marketing expenses over the period of time?
Benefit, how will you recognize as expense? Like, can you just elaborate more if you can give
Like Geo providing 2-year free calling, all
correct?
recognized as Geo phone, and the extra calling may be marketing expenses.
No. So that is incorrect way of recognizing revenue. That is what I was referring to Byju's accounting also. I will share the link with you, or you can search on your own also. Just a second. If I can, there is a video which I have done on Byju's accounting. Just a moment. You can copy this and save with you. Whenever you are free, you can have a look at it. The way you're saying, the calling cost, see, cost is already recognized for providing calling services. For example, Jio says, okay, I'll collect 10,000 rupees, I'll give you a free handset and 2 years of calling. Calling related cost, anyways, I'm recognizing as and when I'm incurring my license fees, my infrastructure cost, and all of that. But where is the revenue for that? See, if I'm giving 2 years of service to the customer and I'm saying that this is my cost incurred, where is the corresponding revenue? And here is where our matching concept comes. For the ACCA class students, I am also pasting the link here. So in the Excel sheet, you can access it subsequently. Okay. So if I'm saying Geo, phone set, and 2 years call. Now with this 2 years call, cost is recognized in P&L over a period of 2 years. Where is the corresponding revenue? I cannot recognize revenue on day one and say I'll incur the cost over a period of 2 years. That violates the fundamental concept of matching income with expenses. And hence, if you're following that approach, it will not be appropriate. And that is where a lot of window dressing can happen. That is where we as accountants and auditors, we have to be extra careful. In fact, for Byju's, that's one reason I believe was the reason for delay in signing of the financials, because 80% of the revenue was being booked upfront, whereas cost would be incurred over a period of 4 years or 5 years time. And that is not appropriate. Okay. Of course, you have to look at materiality also. It is not that, because the rule says so and we have to apply it accordingly. You have to look at materiality also. For example, just to give you a hypothetical situation, today I sell classes. My FR classes say is 15,000. Along with it, mock test I give mock test for free, which is 299 rupees. This comes free. Now, 299 over a 15,000 rupee is not material. So I can say, okay, because it is not material, I can combine both of them and recognize together. But then if I feel this 299 is also material, then out of 15,000, I have to split how much is towards the classes and how much is towards the mock test. And accordingly, I'll have to recognize. Now, for example, doubt clearing. For doubt clearing, I cannot attribute a value. Every day, hundreds of questions are asked on our forums. I cannot attribute a specific value. So such kind of expenses, whenever we are incurring those expenses, we can recognize it as expense. I hope I cleared your doubt, Jatin.
Sir, like you have taken the example of incentives.
Incentives where?
Microsoft example, providing cloud services.
Correct.
That incentive bar will be under the revenue or
no, so that will be reduced. So that will be reduced from the transaction price. On a net basis, Microsoft will be recognizing the revenue. They will not. So what will happen is, let us say, revenue collected is 10,000. And for entering into this contract, if you're paying customer 1,000, you cannot say my revenue is 10,000 and my cost is 1,000. On a net basis, my revenue is 9,000. See, one more thing, please understand. The tax laws, the GST laws, and all of these may show or may ask you to recognize revenue in a different way. This is only from a point of view of accounting. Okay. So don't say that as per GST, we have to show entire amount as revenue upfront. That is a different discussion altogether. Right. So now, let's have a look at this first example. On 1st of December of year 1, Wade receives an order from a customer for a computer as well as 12 months of technical support. Okay, so when is that come? 1st of December. Okay, and please remember, unless specified, financial year would be December itself. Okay. Wade delivers the computer and transfers its legal title to the customer on the same day. We'll come to this legal title aspect, control aspect, and all of that. But just on the same day, the company has transferred how much the computer has been transferred, and 12 months of technical support is also being provided. The customer paid 420 on 1st of December. The computer normally sells for 300 and the technical support for 120. Okay, so 420 is the selling price. Out of that 420, 300 is towards the computer and 120 is towards the technical support. Okay, subsequently we will also understand 300 and 120 may be the independent prices, but supplier may sell the amount to the computer to the customer at a bundled price of 400. In that case, how to allocate that also we'll understand. Okay, so now the 5-step model application of it, let's see. The first one, identify the contract. So there is a contract between the customer, that is the name is not given, the customer and the supplier paid. And what is the contract about? We will provide you custom computer and we will provide you technical services. So that is a part of the contract. Again, it can be written, oral, implied, all of that. So there is a contract. Okay, that's the first part. Then second part is to identify the separate performance obligation within a contract. Inside the contract, how many performance obligations are there? There are 2 performance obligations. The first performance obligation is to supply the computer, and the second performance obligation is the technical support. So supplying the computer is one performance obligation, and providing technical support for a period of 12 months is another performance obligation. Then the third step is to determine the transaction price. Now, the third step is to determine the transaction price. What is the transaction price in total? The transaction price in total is 420. Okay, this is a simple example. Whatever the customer has agreed to pay to the supplier will be considered as the transaction price, right? So that is 420. Then fourth step is to allocate the transaction price to the performance obligation in the contract. So now 420 is allocated as how much? 300 towards the sale of computer and 120 towards the technical support. Now here I would like to just add one more dimension. Say for example, total price was 400. Okay. Independently, the company says if you buy computer, pay me 300, and if you want to buy technical support, you have to pay 120. But if you buy both of them together, I'll give you at 400. Now in this case, tell me how much should we allocate to computer and how much towards technical support? Should I say that 300 is towards computer and 100 is towards technical support? Can I do this? You can reply in the chat box, yes or no, or what you think should be the way to allocate the price. This is the actual price, 300 and 120. But the total amount that I have collected from the customer, because the customer has purchased the computer and also the technical support, I said, okay, please take it for 400 only. I'll not charge extra, 20 rupees discount. So now can I say computer is 300 and technical support is 100? Yes, it will be over a period of time. But what should be the amount that I should say, that how much is towards computer and how much is towards technical support? 280, 120, okay. 3:1.2 ratio. So what we need to do is, what is the actual ratio of actual price independent? We call this standalone price. What is the standalone price? 300 and 120. Standalone price is 300 and 120. So in the same ratio, you will split whatever is this transaction price of 400. This you will split between these two in the ratio of 300 and 120. So some of you said 3:1.2 or 30:12 in that ratio. Basically, take the standalone transaction price and allocate the total transaction price in the ratio of standalone transaction price. So allocation of TP will be the sum of these two, 420. So the allocation of the TP will be 400 divided by 420 multiplied by 300. So 285.71, and then 400 divided by 420 into 120, 114.29. So the total will be 400. So basically, the total transaction price should be allocated to the respective performance obligation in the ratio of their standalone selling price. Right. Now, one more thing you have to keep in mind is, in the given case, we are saying that, this is also 420. So if that is 420, then this also becomes 420 divided by 420 into 300. That is why it has become, that is why it will be 300 and 120 respectively. So total transaction price will be allocated to each performance obligation based on stand-alone selling price. So you have to see on a standalone basis, what is the selling price? On a standalone basis, what is the selling price? And in that ratio, you will allocate the total transaction price. Okay. So 280 and 120 will not be appropriate, because in that case, you are allocating less to the computer and more to the standalone contract. That is about allocation. And lastly, recognize the revenue as and when the performance obligation is completed. So when computer has been delivered, the control over computer is passed. So this will be recognized as revenue in 1st of December or on 1st of December. And the technical support is provided over a period of time. So revenue from this will be recognized over a period of time. We basically 120 over a period of 12 months. So in the current financial year, in December, there is only 1 month left. So for 1 month, the amount attributable is $10. So $10 will be recognized as revenue in the first year, and balance $110 will be recognized as revenue in the subsequent year, right? So this is the summary of 5-step process. Again, quickly, identify the contract, identify the separate performance obligation within the contract, determine the transaction price, allocate the transaction price, and recognize revenue as and when the performance obligation is satisfied. Okay. So that is about the 5-step model. Now, we'll take the first step in more detail, where we said there has to be a contract. What is a contract? That is also defined by IFRS 15. Contract is an agreement between two or more parties that creates enforceable rights and obligation. Now, what is the meaning of enforceable rights and obligation? Once two parties enter into a contract, either of the parties must be in a position to enforce the contract. Means they'll be having a right to ensure that the other party completes their part of obligation. For example, if there is a customer and a supplier, if they have entered into a contract, supplier has to deliver the goods or supplier has to provide the services. The customer has to pay the amount, right? And these rights and obligations, they must be enforceable. Enforceable means parties must be able to enforce in the contract. Or if one party says that I'll not perform the contract, the penalty must be substantially higher. Okay, so that is where we say it is enforceable rights and obligation. Okay, and as we have discussed, the contract can be in writing, in written format, it can be orally, or any other customary business practices. Now, what is this customary business practices? Maybe if you go to a supermarket, you pick up the products. It implies that you have purchased a product and you have to make the payment. Okay, so based on that also, you can identify the contract. Now, an entity can account for revenue if the contract meets the following criteria. So here we'll understand these conditions which must be satisfied for us to bring a contract within the purview of Ind AS 115. So not every contract will come in under Ind AS 115. Some contract may go under IFRS 16 also. So here under IFRS 15, what are the contracts for which you will account for? And please remember, if it fits the criteria of IFRS 15, you will recognize revenue for under IFRS 15. You will show it as revenue item. First one, the parties to the contract have approved the contract and are committed to perform their respective obligation. So the two parties we are talking about, they have approved the contract, means they have signed off the contract and they are committed. They are saying that yes, we will perform our obligation. That's the first thing. Second, the entity can identify each party's right regarding the goods or services to be transferred, and the entity can identify the payment terms for the goods or services to be transferred. So two important aspects. We have entered into a contract. Now, within the contract, we must be able to identify what are the goods or services we are talking about and what are the payment terms and payment conditions. If the payment term is not clear, if the payment term is not clear or payment amount is not clear, then you cannot recognize that under INDS IFRS 15 till the time you get clarity about payment. Okay, for example, payment will be determined after 1 month. So if payment will be determined after 1 month, then only after 1 month you can bring that contract under IFRS 15 because payment is not yet determined. If payment is not determined, how will you account for it? At what amount will you recognize? Correct. So this payment for the terms of the goods and services that must be identified, and what is the obligation of the supplier that must also be identified. Means what kind of goods will be transferred, what kind of services will be provided, over what period of time will it be provided. All of that must be identified. These are simple things. Okay. This becomes more complex if you look at large infrastructure projects and all of that. Otherwise, you go to a shop, you pick up a mobile phone. So delivery of the mobile phone is understood. That is the obligation on the supplier. You'll have to make the payment. That is also understood. So in such cases, it will be simpler. Then the contract must have commercial substance. Now, this commercial substance is, basically it talks about cases where after entering into the contract, the buyer and the seller, they must benefit commercially, and the amount, the way they benefit would be significantly different before entering into the contract. Now, just to give you an example, today, let us say I have a car. I am a dealer in car. I have a car. You are also a dealer in car. You also have a car. I give my car to you. You give my car to me. So basically, we have exchanged these two cars, but the cars are similar. The cars have run over similar number of kilometers. The age of the car is also similar. In that case, there is no commercial substance. I have just given one car to you. I have taken another car from you. There is no commercial substance. But then take the other case. I give my car to you. I take a machinery from you. In that case, the way I will benefit from the machinery will be very different from the way I will benefit from the car. So there it will be a commercial substance, right? So there has to be some or the other form of commercial substance. And lastly, very important, it is probable that the entity will collect the consideration to which it will be entitled in exchange for goods or services that will be transferred to the customer. Very, very important condition. It says that it is probable, means greater than 50% chance that the entity will collect what? Entity will collect amount from the customer to which it is entitled to. For example, if I am selling some goods to you on credit and I have to collect 10,000 from you, it is probable that I'll collect this 10,000 in exchange for the goods or services transferred. So this becomes one of the very important condition to bring a contract under in IFRS 15, that is to recognize revenue under IFRS 15. Other conditions are more or less understood and they are generally present, like approval to the contract. They're committed to perform the contract. You have to identify the goods and services. You have to identify the payment terms. You must be able to understand how much of payment will be received. The contract must have commercial substance. And lastly, there is a probability that you will collect the amount from the customer, right? So if these conditions are satisfied, then you can bring the contract under revenue and recognize it under IFRS 15. If the contract does not have, let's say, commercial substance, then you will not recognize it under IFRS 15. You will deal it with respect to other accounting standards. If payment terms are not clear, once the payment terms are clear, only then you can recognize the revenue. Let's have a look at this example. A company has year end of 31st March of year 6. On January of year 6, Mono company signed a contract with a customer to supply them with an asset on 31st March of year 6 in return for a payment of 360,000 on 30th of September. Control of the asset passed to the customer on 31st of March. Okay. So now, control of the asset passed to the customer on 31st of March. So by 31st March, as a result of changes in the economic climate, Mono company did not believe that it would probably be paid $360,000. Okay. So now we have entered into a contract. We have transferred the goods. The goods have been transferred by 31st of March. But then due to change in economic condition, the last one, it is probable that the entity will collect the consideration to which it will be entitled to. That condition is not being satisfied. Now, when that condition is not satisfied, you cannot recognize revenue. You cannot recognize revenue. So you have to satisfy that condition to recognize revenue. Now, one more thing. Sometimes what happens is sold goods to customer. On date of sale, probable that amount will be collected. Subsequently, doubt on collection. Okay. So now here I'm giving you a scenario where I'm saying that on the date of sale, it is probable that the amount will be collected. So you will recognize revenue. So here you will recognize revenue. Now, subsequently, if there is a doubt on collection, so today when I sold to the customer, I knew I will collect 10,000 rupees from the customer. After 1 month, I realized that this customer will not be able to pay me 10,000. So in that case, should I reverse revenue as per IFRS 15? Should I say that earlier revenue that I have recognized was incorrect and now I'll reverse the revenue? Can I do that, or what should I do? Can you give your thoughts on the chat box? Okay, is that a bad debt? That is one question. Okay. Should I reverse the revenue is the question. Subsequently, if the customer situation deteriorates, should I reverse the revenue? Yes, no, maybe, don't know. That's also an answer. Provision may be created. Okay. Now, please understand, for others it may be new. A trade receivable is which asset? Which type of asset? Yeah, it's a current asset. Current asset is fine. I am expecting from Bhanu and Bala the right answer, what we have understood under financial instrument. It's a financial asset. Okay. Now, once you have recognized a financial asset, then it will be governed by IFRS 9. So you'll have to go to IFRS 9. See, under IFRS 15, you would say recognize revenue. You'll create a trade receivable. Now, this trade receivable will be governed by IFRS 9. And under IFRS 9, you will talk about impairment. So basically, what you would have thought, you will create something called a provision for bad debt. But if at the time of entering into the contract, or if at the time of transferring of control, in this case, at the time of transfer of control on 31st March, we realize that it is not probable that the amount will be collected. So you cannot recognize revenue itself. Okay. So very careful. The reason for this clause is to ensure that you don't unnecessarily inflate the revenue. Otherwise, what will happen? You will show a higher revenue and then you will say there is a bad debt. Okay. And these days, everything is revenue multiple, valuation is based on revenue multiple and all of that. So in that is why the standard says, boss, on the date on which you have transferred the control, if you believe that the amount will not be collected, then don't recognize revenue. And then no point in creating bad debt and all of that. Okay. So we have understood the 5 steps. And under the first step, we have understood that there must be a contract. Parties must have approved the contract. You must know what is the good, what is the service. You must know what is the payment term. There must be commercial substance, and there must be a probability of collection, more than 50% chance, right? So with this, we will conclude the first session. And in the next class, that is on Thursday, we'll continue with step 2. Okay. In the meanwhile, if you have any doubt, you can ask me. I'm available for another 4-5 minutes. Otherwise, we'll catch up on Thursday, that is 9th of February.
Sir, in same class of customers, payment terms may be different. So how will it?
It'll be different. If it is customer by customer, you have to see the payment terms may be different.
So like we are providing cash discount to some particular customer, it will be charged to P&L or recognized from revenue?
Cash discount. Now, cash discount comes when? Cash discount comes at the time of payment. Okay. So when cash discount is provided at the time of payment, you will show it as a discount expense. At the time of sale, if you are giving some discount, that is a trade discount. That is not a cash discount. Okay. Trade discount will automatically be reduced from the transaction price. For example, today my course is at 10,000. I am running a special offer of 15% off. So if I'm running an offer of 15% off, so my net revenue I'll recognize will be at 8,500. But if it is a discount for prompt payment, that will be a normal discount expense.
So trade discount is meant for all customers, according to me.
It may be meant for all customers. It depends from from business to business.
But we are providing to a particular customer discount.
It's okay. So you have to do it on transaction to see. You need to understand that you have to do accounting based on each contract. So with 10 customers, if you have 10 different types of contract, accordingly you'll have to recognize the revenue.
Okay, sir.
Okay. Chalo. Any doubt in this 5-step that you have discussed? If anyone has any question, feel free to ask. Okay. So
here in illustration 2, what we have saw, the asset is sold, sir,
correct.
and they've not recognized the revenue.
Correct.
How would be the accounting treatment actually be done, sir?
So what will happen is you may, so for example, here they are supplying an asset. Okay. So they're supplying an asset. Asset has gone out. You may create a receivable, but you will not recognize revenue.
Receivables, yes, sir.
Or you can say the asset, you see, control has been passed, right? So that asset, you cannot show it in a balance sheet now. So you will say there is a receivable to asset, but there is no revenue. So one thing you have to understand is under IFRS 15, you cannot recognize the revenue. You can still say, okay, let's say, for example, I gave you 1 lakh worth of an asset. I can say 1 lakh is receivable, but it is not yet a revenue. Revenue can be recognized only when these conditions are satisfied. Okay. Thank you. Thanks for joining.